SpaceX, OpenAI, Anthropic. The conventional wisdom on Wall Street right now is that the public markets are shrinking, and you are missing out on the next Google. By the time these massive tech giants actually go public, the massive 100x gains have already been extracted by billionaires and institutions. You are just fighting over the scraps. But if you have looked at your 401k recently, you might notice something shifting. Wall Street asset managers are aggressively lobbying to get private equity and venture capital inside your standard target date retirement funds. They are calling it democratized access. They are pitching it as a way for the average worker to finally level the playing field and get a piece of the private market action before the IPO. On paper, it sounds incredibly compelling. The problem is, when you strip away the marketing brochure and look at the brutal mechanical realities of wrapping a highly illiquid asset inside a daily liquidity vehicle, the math completely falls apart. You are not getting democratized access to the next SpaceX. You are being positioned as the exit liquidity for a decade of bad institutional bets. Let me show you exactly how this trap works. To understand why this narrative is so powerful, we have to acknowledge the one thing Wall Street is actually right about. Companies are absolutely staying private longer. If we rewind to 1997, Amazon went public at a valuation of roughly $438 million. That allowed regular retail investors to buy in early and ride the wave all the way to a $1 trillion market cap. Today, that simply does not happen. Companies like Rivian or Uber do not go public until they hit $80 or $100 billion valuations. That hyper-growth phase occurs entirely behind closed doors in the private sector. At the same time, the total number of publicly traded companies in the US has dropped from about 8,000 in 1996 to roughly half that today. Asset managers know that the average American worker is feeling the squeeze of inflation and stagnant real wages. The promise of venture capital returns in a retirement account feels like a necessary lifeline. Before we pull apart the numbers, if you want to optimize your wealth without the Wall Street spin, hit subscribe. It is the highest ROI click you will make today. The emotional hook Wall Street uses here relies on something behavioral economists call salience bias. It is the unicorn illusion. As humans, we easily recall the legendary stories of the $10,000 angel investment in a ride-sharing app that magically turned into $50 million. Those stories are salient. They stick in our brains. What we do not recall are the thousands of startups that went straight to zero because nobody writes articles about them. Asset managers aggressively market the names of household AI and space companies, fully knowing that the typical private sleeve in your 401k will not actually hold them. To absorb the massive, continuous, bi-weekly capital inflows from millions of payroll deductions, these funds have to deploy cash constantly. They end up heavily diluting the portfolio with completely mundane middle-market buyouts. You think you are buying into the future of artificial intelligence, but you are actually buying a regional HVAC roll-up company or a conglomerate of strip mall dental practices. It is a classic bait and switch, packaged under the glamour of exclusive private markets. So we know the pitch, and we know the emotional trap. But where this gets genuinely dangerous is in the structure of the product itself. To defend yourself, you have to understand the fundamental mismatch between the asset and the wrapper. Private equity is fundamentally illiquid. When a fund buys a private company, that money is locked up for 7 to 10 years. You cannot just click a button and sell a fraction of a dental practice on a Tuesday afternoon. But your 401k is mandated to offer daily liquidity. When you retire, or change jobs, or rebalance your portfolio, you expect that money to move instantly. Putting a 10-year lock-up asset into a vehicle that requires next-day cash settlements is like trying to fit a square peg into a round hole using a very expensive hammer. The only way Wall Street can make this work legally is by introducing layers of friction. And in finance, friction always equals fees. Let us look at the actual math of what happens to your dollar when it crosses the threshold into these new alternative target date funds. If you think missing out on the next big tech IPO is painful, wait until you see the exact mathematical drag of buying private assets inside a retirement wrapper. Most people stop at the gross return and lose tens of thousands of dollars over their career. Here is the step they miss. Let us fast forward and run a basic one-year scenario with $10,000, comparing a boring public index fund against an exclusive private market sleeve. For the public side, let us assume the S&P 500 gives us a completely average 9% gross return for the year. Your expense ratio is roughly 3 basis points, which is practically free. You pay $3 in fees, and your net return is 8.97%. You end the year with $897 in pure profit. Simple, clean, and highly efficient. Now, let us look at the private equity sleeve in the 401k. The glossy brochure promises a massive 14% gross return. On paper, it looks like a landslide victory for the private markets. But we have to pay the toll. The first layer of the trap is the cash drag. Remember that liquidity constraint we just talked about. Because your 401k requires daily pricing and the ability to handle daily withdrawals, the private equity manager cannot actually invest all of your money. They are forced to hold a liquid buffer. Typically, about 15% of your capital just sits in a cash or money market account, yielding maybe 4.5%. So out of your $10,000, only $8,500 is actually invested in those high-flying private companies earning 14%. The remaining $1,500 is dragging along at cash rates. When we blend those two together, your actual gross return on the total $10,000 immediately drops from 14% down to 12.57%. The massive outperformance you were promised has already been severely kneecapped before a single fee has even been deducted. You are holding the risk of the private markets, but 15% of your money is doing the exact same job as a basic high-yield savings account. The second layer of the trap is the management and administrative wrapper fee. It takes a lot of expensive lawyers, accountants, and fund of funds managers to artificially cram an illiquid asset into a mutual fund structure. You will generally pay a blended management fee of around 2% on your total assets under management. On our $10,000 balance, that is a flat $200 gone. Now your gross return is down to $1,057. But we are still not done. The third layer is the performance fee, historically known as carried interest. The private equity manager generally takes 15 to 20% of the profits generated by the private investments. In our scenario, the private sleeve generated $1,190 in raw profit. The manager slices off 15% of that, taking another $178 right out of your pocket. You took 100% of the downside risk on these unproven companies, but Wall Street is siphoning off a massive chunk of the upside just for doing the paperwork. So let us calculate the final, brutal reality. Your exclusive private equity fund generated a massive 14% gross return, crushing the public market by 500 basis points. But after the cash drag, the 2% management fee, and the carried interest, your actual net return is $879. That is an 8.79% net return. Let that sink in. The boring, completely passive S&P 500 index fund netted you 8.97%. The private fund netted you 8.79%. The retail investor actually underperformed the vanilla index fund despite taking on drastically more complexity and locking up their money. Academic finance dictates that tying up your capital in illiquid assets requires an illiquidity premium of at least 3% over public markets to be worth the risk. If fees and cash drags consume that entire premium, the mathematical justification for owning the asset completely disappears. The premium existed, but it was entirely captured by the Wall Street asset managers, not your retirement account. We will get to the exact portfolio protocol you need to filter these funds out in a minute. But first, we need to address a massive psychological leak. Why do incredibly intelligent professionals consciously opt into these expensive products, even when the math is terrible? It comes down to something called volatility laundering. If you own the public S&P 500, you feel the psychological pain of the market immediately. When the market drops 2% on a random Tuesday, your portfolio flashes red. You see the loss. Public markets are marked to market every single second of the trading day. Private equity, on the other hand, is priced by appraisal, and usually that only happens once a quarter. If a private company's fundamentals deteriorate, the manager does not have a live ticker symbol forcing them to admit it. They can simply delay marking down the valuation. They stretch the truth to make the ride look incredibly smooth. It acts like a funhouse mirror for your money, hiding the reality of the bumps. Because the private fund only updates its price occasionally, it mathematically appears to have much lower volatility than the public stock market. Investors look at the chart and think they have found a magical, stable asset class that goes up in a straight line. But this is a fundamental misunderstanding of risk. You are mistaking unpriced risk for reduced risk. Not stepping on a scale for a year does not mean you didn't gain weight. It just means you refused to measure it. The underlying business volatility of a private startup is actually much higher than a mature public company like Apple or Microsoft. By shielding you from the daily price swings, the asset manager tricks your brain into thinking the high fees are justified for the peace of mind. But you are paying a massive premium for a psychological illusion, while holding businesses that are statistically far more likely to go bankrupt during an economic downturn than anything in the public index. The most insidious part of this entire structure is what economists call the principal-agent problem. Specifically, it is the dark secret of exit liquidity. To understand why Wall Street is pushing so hard to get into your 401k right now, you have to look at the macroeconomic environment. Early-stage venture capitalists and institutional endowments have trillions of dollars tied up in private companies that matured during the zero-interest rate era from 2010 to 2021. Money was free, valuations were sky-high, and everyone was getting rich on paper. But with interest rates now sitting much higher, the traditional IPO markets are incredibly constrained. Public market investors are no longer willing to buy wildly unprofitable tech companies at ridiculous multiples. The traditional exit doors have been locked. These massive institutional funds need a way to cash out their early investments. They need a buyer who does not care about the price and just buys on a set schedule. Enter the American middle class. By opening up 401k plans to private assets, Wall Street creates a massive, price-insensitive buyer. Think about it. Billions of dollars in automatic payroll deductions flow into retirement accounts every 2 weeks, blind to the current state of the economy. In a financial relay race, the baton is passed from the founder to the angel investor to the venture capitalist to private equity and finally to the public market. By injecting private assets into target date funds, Wall Street is making the retail worker the final anchor runner. You are receiving the baton at the very end of the race when the hyper-growth phase is already over. You are serving as the exit liquidity so the early institutional investors can lock in their profits. You are absorbing their risk, paying a premium management fee to do it, and getting entirely average returns in exchange. Now that we see the game board clearly, we need a specific defensive protocol to protect your capital. If you want to stop serving as Wall Street's exit liquidity, you have to run a strict audit on your employer plan. Conventional wisdom says to just pick the target date fund that matches your retirement year and close your eyes. I am going to tell you to look under the hood right now. This is the Optimizer's protocol. First, we run the expense ratio threshold test. Log into your provider and look at the core investment menu. Find your target date fund or your diversified growth portfolio and check the net expense ratio. If the expense ratio is under 0.10%, you are likely looking at a pure, highly efficient public index fund. You are safe. But if that expense ratio is creeping over 0.45%, warning bells should be ringing. It almost certainly contains active management, hedge fund replication, or expensive private market sleeves. Mathematically, it is practically impossible for a target date fund to overcome a 0.45% fee drag over a 30-year investing horizon. The tricky part is that Wall Street is increasingly hiding these private allocations inside things called collective investment trusts, or CITs. Unlike mutual funds, CITs do not have ticker symbols, and they have much looser regulatory disclosure requirements. You cannot just type them into Yahoo Finance to see what is inside. You have to pull the plan's annual fee disclosure document and specifically search for terms like alternative allocations, private credit, or unlisted equities. Now, bridging the gap between learning this math and actually optimizing your portfolio is usually where people get stuck. That is exactly why I built Cash Class, the official Tom Talks Money web platform. It is a completely privacy-first financial architecture tool. There are absolutely no bank logins required. You just securely upload your CSV statements, and the system helps you map out these exact hidden fees and calculate your true net worth trajectory. It even includes a free Budgeting 101 course to get your baseline dialed in. You can start a 14-day free trial right now by clicking the link at the very top of the description below. Get the math right on the web, then get back to your life. Once you have identified the expensive, bundled target date funds, the next step is the core and satellite disaggregation strategy. Optimizers do not buy bundled products where the institution dictates the exposure and charges a premium blended fee. Instead, unbundle the portfolio yourself. For your core, which is inside your 401k, allocate 100% of your capital to the lowest cost broad market index funds available on the menu. A basic S&P 500, a Russell 2000, and a total bond fund. You control the exact asset allocation and you pay practically zero in fees. If you genuinely want high-risk, high-reward venture capital exposure, make that your satellite strategy. Do it entirely outside of your retirement account using after-tax money. You can participate in equity crowdfunding, make direct angel investments, or heavily weight the stock of the actual company you work for. You can take private market risks without paying a middleman a massive performance fee just to index unlisted companies on your behalf. The final defensive layer is the gating assessment. If you are ever forced into a fund with private assets, or you intentionally choose to hold one, you must read the liquidity provisions. In a severe market downturn, funds with heavy private holdings can actually enact gates. This means they legally freeze your ability to withdraw your own money. They do this to prevent a run on the fund because they simply cannot sell off regional dental practices or HVAC companies fast enough to pay out cash to retiring employees. Do not let the daily liquidity illusion fool you. In a panic, the doors lock. Never put capital into one of these blended vehicles if you absolutely need to roll it over, withdraw it, or borrow against it within the next 5 years. Remember the rule of 72. At an 8% return, your money doubles every 9 years. If fee drag reduces you to 6%, it takes 12 years. Over a long career, a 2% drag literally cuts your terminal wealth in half. Think of your investment choices like choosing a restaurant. The public index fund is essentially a $10 all-you-can-eat buffet. It is not glamorous, nobody is taking pictures of it for social media, but it has absolutely all the calories and nutrients you need to survive and thrive. The private equity sleeve in your retirement account is the velvet rope VIP room in the back of the nightclub. You are paying a massive cover charge just to feel exclusive, but once you get inside, you realize you are drinking the exact same cheap water as everyone else. The premium you are paying is purely for the ego, not for the utility. You do not need exclusive access to build generational wealth. You just need relentless consistency and aggressive fee avoidance. If you are serious about this mindset, click the join button below this video to become one of the optimizers. You get priority replies in the comments and custom sketch badges, but more importantly, you are supporting independent financial research that does not rely on Wall Street sponsors. The overarching danger of private equity in retirement accounts boils down to sequence of returns risk. Most retail investors are blindly dollar cost averaging every 2 weeks. If you buy into these private funds, you are acquiring unlisted companies at whatever the prevailing bloated valuation happens to be the day your paycheck clears. It completely removes the one tactical advantage that institutional private equity firms actually have, which is the ability to time their capital calls and buy during deep market distress. You get all the structural friction and none of the strategic edge. Do not pay for the illusion of stability. Stick to the public, liquid, and radically cheap indices that have built more middle-class millionaires than any unicorn startup ever will. I want to hear your peer review on this. Have you checked your employer plan recently? And did you find any hidden alternative asset classes in the fine print? Drop your findings in the comments below so we can gather the data. Keep compounding, keep optimizing, and I will see you in the next one.